You are listening to The Vocal Technologist. Spoken tech for your ears.
I want you to just imagine for a second trying to buy a multi-million-dollar satellite thruster.
Right. Not your everyday purchase.
Yeah, exactly.
Yeah.
But imagine the money has to sit in this highly specialized escrow account while a bunch of international lawyers argue over whether that specific piece of hardware is, well, legally classified as a weapon.
Which happens a lot more than you'd think in that industry.
Right. And meanwhile, down here on Earth, the digital wallet that's sitting in your pocket right now is quietly earning interest that's backed by U.S. Treasuries. And it's completely ignoring the traditional banking system to do it.
It's sort of a massive split screen of how money is working right now.
It really is. The borders of where and how money moves, they aren't just shifting anymore. They are honestly entirely evaporating. And that's what we're getting into today.
Yeah, it's a profound geographical shift.
Just exactly. Welcome to today's deep dive. We have a really fascinating stack of tech and fintech dispatches to go through with you today. And our mission is basically to map out this new geography of money. We are covering everything from literal outer space transactions to AI-driven fraud at the upcoming World Cup.
And for a long time, we pictured the borders of money as being incredibly concrete, right?
Like heavy steel bank vaults.
Exactly, or just the physical brick and mortar branch on your corner. But as we look at today's developments, going from these macro level regulatory battles all the way down to microscopic AI algorithms, the one overarching theme here is that the infrastructure of money is now completely indistinguishable from the infrastructure of technology.
Okay, so let's start with the base layer of that new infrastructure, which is digital money itself. The stablecoin wars are escalating.
Big time.
Yeah, and the traditional establishment is striking back in this way that we haven't seen this before. There's this massive coalition that just formed. We were talking Visa, Stripe, BNY, BlackRock, Coinbase, Chime, Klarna, and Alphabet.
That's essentially the Avengers of traditional finance and big tech assembling.
Right, it's a crazy roster. And they are backing a new venture called Open Standard. And they're issuing their own dollar-backed stablecoin called OpenUSD.
And their target is very clear. They want to challenge the absolute dominance of those legacy stablecoin issuers like Tether and Circle.
But it's their strategy that really caught my eye. Because they aren't just trying to, build a better token. They're completely flipping the business model on its head.
They really are.
The brief says they are planning to distribute the reserve yields among the participating firms. So help us understand the mechanics here. Why is that specific move so dangerous to the incumbents?
Well, to understand the threat, we have to look at how a stablecoin actually makes money in the first place.
Right.
When you buy a token from a dominant issuer, you give them a real U.S. dollar.
Right.
They take that real dollar and they buy a highly liquid, safe asset, which is almost always a U.S. Treasury bill. Now, right now, those Treasury bills pay interest or yield.
Right, because rates are up.
Exactly. And historically, the issuers simply kept all that interest for themselves.
Wait, all of it?
All of it. So if you have $100 billion in circulation, you are generating billions in pure profit just from the yield. It is arguably one of the greatest business models ever created.
And Open Standard is walking in and saying, we aren't going to keep that profit.
Precisely. They are weaponizing the yield. Open Standard is essentially telling these massive payment apps and banks and merchants, hey, if you integrate our specific infrastructure, OpenUSD, we will share the interest we earn on the underlying reserves directly with you.
Oh, wow. So it completely changes the incentive.
It fundamentally rewires it. Suddenly, for a company like Stripe or Chime, holding customer balances in OpenUSD isn't just a way to, facilitate payments. It transforms that float into a direct revenue stream.
So they're essentially financially bribing the entire ecosystem to adopt their standard.
Yeah, by giving up the monopoly on the yield.
That is just brilliant. Why fight a war of attrition when you can just offer to share the box office profits with all the theaters, right?
That's a great way to put it.
But as these titans are building out these global currency networks, the regulators are obviously scrambling to figure out how to put a leash on them. Which brings us to the UK.
Right, the Financial Conduct Authority.
Yeah, the FCA. They recently proposed a stablecoin issuer capital requirement of 2%. But after a ton of industry pushback, they just slashed it down to 1% of outstanding issuance.
Which is a massive reduction.
It's half. So I have to ask, is a 1% capital requirement actually enough to protect consumers? Or is the UK just blinking in this game of global regulatory chicken because they're terrified of losing these tech companies to the US?
It's definitely a very delicate balancing act between consumer protection and, well, global competitiveness. Let's break down the mechanism of that requirement first.
Okay, let's hear it.
A capital requirement isn't the reserve backing the coin itself, right? The coin is backed one-to-one by treasuries. The capital requirement is an additional operational buffer.
Got it.
So if an issuer has, say, $10 billion of stablecoins in circulation, a 2% rule forces them to lock up $200 million of their own corporate cash, just in case there's a catastrophic operational failure or, like, a sudden run on the bank.
Which is capital they can't use to hire engineers or build products or expand into new markets.
Exactly, yes. It is basically dead weight on their balance sheet. So by dropping that requirement to 1%, the UK is freeing up half of that capital.
So what's the FCA's excuse for dropping it?
Their rationale is that the underlying treasury reserves are secure enough that a 1% operational buffer is mathematically sufficient to manage the risk.
I mean, sure, the math might work.
But zooming out, you really cannot ignore the timing here. Capital goes where it is treated best. The UK is acutely aware that if they create a regulatory environment that is significantly more punitive than what might emerge in the US or the UAE.
These huge coalitions like Open Standard will just pack up and bypass London altogether.
Exactly. The UK is adjusting the dial to ensure they remain a global hub for this new financial plumbing.
Okay, so we're seeing the actual form of money changing as tech giants corporatize the stablecoin. But we also really need to talk about where this money is flowing.
Right, the geography is shifting.
Because while Western regulators are, tweaking capital requirements for digital dollars, emerging markets are scaling at a pace that is honestly hard to comprehend. And Silicon Valley is looking past Earth entirely.
Yeah, the expansion is happening on two completely different vectors right now, hyperlocal scale and hyper-complex frontiers.
Okay, let's look at the hyperlocal first. We have Mint, which is the operator of the Philippine e-wallet Gcash.
A massive player.
Huge. They are seeking a $1.5 billion IPO. This could be the country's largest ever. And it would potentially value the company at $10.9 billion.
Those are staggering numbers.
Right. And they're boasting 90 million registered users and 40 million monthly active users.
Yeah.
But I look at a nearly $11 billion valuation for an app that operates primarily within a single country's borders, and I have to push back a little.
Okay, what's your hesitation?
I mean, is the market in the Philippines genuinely that expansive to justify that number, or are we just seeing peak e-wallet hype right now?
It's a fair question, but if you view Gcash simply as a digital alternative to a checking account, then yeah, that valuation looks inflated.
Right.
But you have to understand the sheer density of those user numbers. The total population of the Philippines is roughly 115 million.
Okay.
So having 40 million monthly active users means that a massive dominant portion of the entire adult population is transacting entirely within this one single ecosystem.
Wow. So it's not just peer-to-peer payments anymore. It's everything.
Far from just payments. In traditional Western finance, your financial life is highly fragmented.
Right. I've got a checking account at one bank, a credit card from another.
Exactly. A brokerage account somewhere else, you buy insurance from a completely different broker. Gcash has basically bypassed all that fragmentation.
Because they got everyone on payment layer first.
Exactly. Because they captured the payment layer so thoroughly, they became the foundational operating system for everything else. They are handling massive volumes of microlending, wealth management, and insurance directly through the app.
Oh, I see.
Yeah. So when you capture the holistic financial life of a country's workforce, the valuation isn't just a multiple of transaction fees. It reflects the monopolistic utility of the platform itself.
They literally became the entire financial infrastructure in one download.
Yes, a totally closed-loop system.
That is wild.
Yeah.
Now, contrast that incredibly frictionless, hyper-local system with what is happening in the space economy.
Oh, this is fascinating.
Alphabet's GV just led a $30 million seed round for a startup called Nebex, and it's founded by former Axiom Space CEO Tejpal Bhatia.
Right. He knows this world intimately.
Clearly. So Nebex is an online marketplace connecting U.S.-based companies, foreign governments, and investors to facilitate large cross-border space transactions.
And this is where financial friction reaches its absolute peak.
Yeah, I read the brief on Nebex, and I just kept thinking of them as this, cosmic escrow agent.
That's actually a great way to think about it.
You are moving hardware and capital that involves export controls, tariffs, and just intense national security restrictions.
The comparison to escrow is really apt, but the mechanism is incredibly complex because space finance isn't just about ensuring the wire transfer clears.
Right, it's not just sending a check.
No, moving aerospace technology involves navigating ITAR, the International Traffic in Arms Regulations.
Oh, right, because of the hardware.
Exactly. It involves agonizing over dual-use technology restrictions. Because, the same guidance system that puts a commercial satellite into orbit.
Could theoretically be repurposed for a ballistic missile?
Exactly. So every single cross-border transaction in the space economy is essentially a bespoke diplomatic event.
Which just sounds like an administrative nightmare.
It is. And NEBEX is attempting to build the standardized financial plumbing to verify compliance across multiple sovereign jurisdictions simultaneously. They are ensuring that capital can flow into space without accidentally violating international arms treaties.
Which means the verification systems they use have to be completely flawless.
There is zero room for error.
You can't have a bad actor slipping through the cracks when you are dealing with orbital technology. But, that drive for flawless verification leads us perfectly into the dark side of all this speed and scale.
Ah, yes, the fraud.
Because as money moves faster and across these much more complex platforms, the criminals are weaponizing the exact same underlying technology.
It's a rule of thumb in this industry. The velocity of transaction always directly correlates with the velocity of fraud.
And we are seeing this play out right now on a massive consumer scale with the upcoming World Cup.
It's going to be a real stress test.
Payment security firms are bracing for an absolute avalanche of chargebacks. Fraudsters are using AI to spin up these highly sophisticated fake websites, flawless phishing campaigns, and counterfeit offers for tickets, travel, merchandise.
And AI just makes it so cheap to produce these fakes at scale.
Exactly. And it creates this terrible lose-lose scenario. If the transaction goes through, the merchant gets hit with a devastating chargeback when the fraud is actually discovered.
But if the bank's security system is too paranoid...
Right. Legitimate fans get hit with false declines, completely ruining their experience.
And a false decline is incredibly costly.
How so? Like beyond just annoying the customer?
Well, think about it. If you travel internationally for the World Cup and you try to buy a jersey at the stadium and your card is declined because some legacy algorithm flagged a foreign transaction as anomalous, you don't just put the jersey back.
No, I'm pulling out a different card.
Exactly. You likely pull out a competitor's credit card. So the original bank loses the interchange fee on that transaction, the merchant loses the seamless sale, and the bank risks losing your loyalty entirely.
Because now I don't trust that card to work when I travel.
Exactly.
So to fight back against this, a company called Quantified just raised a $200 million growth round, led by Summit Partners, to expand their AI-native risk intelligence platform.
It's a massive raise for this space.
Huge. And they're investing heavily in what they call, and prepare yourself for this, graphite agentic middleware.
I know, it sounds like pure science fiction jargon.
It really does.
Yeah.
But the brief says it's an orchestration layer using explainable AI, entity resolution, and relationship intelligence.
No.
And the goal is to reduce false positives in anti-money laundering and sanctions screening, all while maintaining human auditability.
It's a dense term, but the mechanics behind it are actually fascinating.
Well, let's break this down because it really feels like an arms race, right? The fraudsters use a black box AI to generate this flawless fake travel package. And the banks have to go buy Quantified's AI just to spot it.
Yes, fighting fire with fire.
But what exactly does explainable AI mean here? Like, I'm thinking of a math test analogy. Traditional AI just writes down the final answer. If it flags a transaction as fraud, it just says 99% probability of fraud. But how does a human auditor actually verify that?
Your math test analogy is exactly right. In traditional AI, the neural network calculates millions of variables and just spits out a binary decision, block or approve.
Right. It doesn't show its work.
And in the context of global finance, especially regarding anti-money laundering and sanctions, that black box is legally unacceptable.
Because the regulators demand to know why.
Exactly. If a bank freezes a massive transaction and a regulator asks why, the bank cannot just say, "We don't know, the algorithm told us to." Explainable AI is forced to show its work on the paper.
Oh, so it provides the actual
Yeah.
evidence. Okay, so where does the entity resolution part fit into showing its work?
Think of entity resolution as a digital private investigator.
Right.
fraudsters don't use real names, right? They use synthetic identities. So entity resolution doesn't just look at the name on the transaction. It mathematically links all these disparate data points.
Like what kind of data points?
The IP address, the shipping address, the device ID, even the behavioral cadence of how the user types on their phone.
Wow, how fast they type.
Yeah. The explainable AI then maps this all out and says to the human auditor, hey, we flagged this World Cup ticket purchase because while the name says John Smith in London, the device ID is the exact same one used in a known phishing attack in Moscow 3 months ago, and the payment is being routed through a high-risk jurisdiction.
Oh, so basically hands the human auditor a completely readable, logical map of the crime.
Exactly. The human isn't recalculating the AI's math, they are just reviewing the evidence the AI gathered.
That makes total sense. So it maintains the lightning speed of machine learning, but it keeps the accountability that's required by financial law.
It resolves the tension perfectly. You need AI to spot AI-driven fraud, but you still need that human oversight to satisfy the regulators.
Okay, so banks are using these advanced models to predict and isolate fraudulent behavior before it happens. But as we move into our final set of dispatches today, we are seeing this desperation to accurately predict and monetize the future showing up absolutely everywhere.
The search for certainty is really the defining characteristic of the current market.
It totally is. Businesses are trying to engineer predictability in a very chaotic landscape. Let's connect some of these dots.
Okay,
First, prediction markets are pushing into the mainstream, and it is incredibly messy.
very messy.
Polymarket is facing deceptive advertising allegations. Meta is reportedly exploring building its own prediction market app into its social ecosystem.
Which is a huge development.
Massive. And the Commodity Futures Trading Commission, the CFTC, is actively clashing with state regulators over who even has jurisdiction over these platforms.
Right.
Meanwhile, in the more traditional lending space, SoFi is moving aggressively into small business loans. They're offering anywhere from $2,500 to $250,000 with zero application, origination, or prepayment fees.
Stripping away the friction to lock in the customer.
Exactly. And to help lenders figure out who actually deserves those loans, mortgage giants Fannie Mae and Freddie Mac just released over 12 years of historical mortgage performance data, specifically tailored for the FICO 10T score.
That's a huge data dump.
It is. And finally, in the battle for predictable distribution, Klarna just won $1.5 billion in antitrust damages against Google in a Swedish court, proving that Google unfairly prioritized its own shopping comparison service.
Now, on the surface, those four developments, betting markets, zero-fee loans, credit data, and antitrust lawsuits, they look entirely disconnected.
Right, totally random.
But they are all distinct mechanisms that companies are utilizing right now to carve out fair play and predictability.
Well, let's start with the prediction markets, because they are essentially the financialization of the phrase, "I told you so."
That's exactly what they are.
You put your money where your mouth is on a future event. But if a giant like Meta integrates this, aren't we just turning our daily social feeds into a giant unregulated casino? Like, why are the state and federal regulators fighting over this?
The jurisdictional clash happens because the technology just doesn't fit neatly into legacy definitions.
Okay.
State regulators typically view event contracts, betting on an outcome through the lens of gambling laws and local consumer protection.
Right, like a sports book.
Exactly. The CFTC, however, views these markets through the lens of derivatives and commodities trading.
Oh, interesting.
Yeah, their federal mandate is to ensure market integrity, prevent manipulation, and protect systemic financial stability. So a decentralized prediction market exists in this weird gray area between a sportsbook and a futures exchange.
And if Meta gets involved?
If a platform with Meta's immense scale enters the space, it forces a resolution. You can no longer ignore the gray area when 3 billion people suddenly have access to it on their phones.
So it forces the regulators to clearly define what is a financial derivative and what is just plain gambling.
Precisely.
Now, how does that search for certainty connect to what SoFi is doing with small businesses or what Fannie Mae is doing with all that FICO data?
It comes back to engineering predictability. So SoFi offering zero-fee loans is a strategic bet on the future value of that customer.
Because small business lending is usually full of friction, right?
Exactly. Fees, paperwork, waiting periods. By removing the upfront costs, SoFi is acquiring a highly valuable, sticky customer base. They are engineering certainty by getting the customer into their ecosystem today, betting they will monetize that relationship across other financial products tomorrow.
They're buying the relationship.
Exactly.
And what about the FICO 10T data release?
That is all about predictive accuracy. The T in FICO 10T stands for trended data.
Trended data, okay.
Older credit models basically took a snapshot of your debt at a single moment in time. So if person A and person B both have $10,000 in credit card debt today, the old model treats them somewhat similarly.
Right. They look the same on paper.
But trended data looks at a 24-month trajectory. What if person A had $5,000 in debt last month and is trending dangerously up?
While person B had $15,000 last month and is aggressively paying it down?
Exactly.
They have entirely different risk profiles, even though their snapshot today looks identical.
Precisely. By releasing 12 years of historical mortgage data mapped against this trended model, Fannie Mae and Freddie Mac are providing empirical proof across multiple economic cycles.
So lenders don't have to guess if the new algorithm works.
No guessing required. They have over a decade of hard evidence showing exactly how it predicts defaults. It completely removed the guesswork from lending.
Which brings us to Klarna suing Google. Because if you are building a business, you have to be able to predict your revenue. But if you are a shopping comparison service like Klarna, and Google manipulates its search algorithm to bury your links and promote its own competing service, your future revenue prediction drops to zero.
Yes. Klarna's antitrust victory is a legal mechanism to enforce predictability in digital distribution.
Okay.
In the modern economy, access to search traffic is the equivalent of physical foot traffic in a mall.
That's a great analogy.
If the landlord, in this case, Google, can arbitrarily cut off your oxygen to favor their own store, you cannot build a predictable business model. So the $1.5 billion judgment acts as a structural guardrail, ensuring a level playing field for future competition.
It is all about building systems that function exactly the way they're supposed to function.
Exactly.
Whether that is a smart contract on Polymarket, a trended credit score, or a fair search algorithm, which really pulls this entire deep dive into focus.
It really connects all the dots.
We started by looking at how the physical borders of money are evaporating and tracking everything we've explored today. I mean, from the UK slashing capital requirements to keep the Open USD coalition in London, to Gcash swallowing the entire financial life of the Philippines, to Nibex navigating the bespoke diplomacy of space transactions.
And quantifying deploying explainable AI to catch World Cup fraudsters.
That's right. The overarching synthesis here is impossible to ignore. Finance is no longer this localized, distinct sector managed solely by bankers in tall buildings.
Not at all. It is actively being architected by tech platforms, AI developers, and space entrepreneurs. The plumbing of money is now a purely technological arms race.
And that leaves me with a thought that I really want you, the listener, to mull over as you navigate this shifting landscape. If traditional financial giants successfully absorb stablecoins into their own automated networks,
Which they are trying to do.
right, and if incredibly advanced explainable AI systems eventually handle all the risk profiling, loan approvals, and fraud detection without us even noticing, are we approaching a future where the concept of money is no longer a human exchange at all?
That's the real question.
What happens when our entire economy is just an automated, frictionless, algorithmic agreement firing back and forth between bots? And if our financial reality becomes completely mathematically optimized, where exactly does the messy, unpredictable element of human intuition fit into our financial future?
When you engineer all the friction out of the system, you really have to wonder what else you're removing in the process.
It's a profound space to leave it. Thank you for joining us on this deep dive. Keep exploring, keep cutting through the noise, and most importantly, keep questioning those evaporating borders around you. We'll catch you next time.
Spoken Tech for your ears.